I wanted to do another show on special purpose acquisition company or SPAC madness and how this is a perfect example of the Cantillon effect of all this currency and credit being used for waste, fraud, corruption, and abuse, and allowing insiders, whether that's Wall Street banks, private equity, hedge fund managers, big name billionaires with easier access to capital to buy up assets for pennies on the dollar and to get asset price inflation. I was looking for expert comments and opinions about the SPACs and how crazy things have been getting things have been getting crazy for a couple years now, but early in 2020, once the pandemic started, and in the policy responses from the Federal Reserve, other central banks, and the U.S. Treasury started to accelerate in February, March, and April, things have just gotten out of hand. So I want to play some quick clips here from experts like the former CEO of Goldman Sachs, Lloyd Blankfein, who apparently took a break from doing God's work to do an interview on CNBC on Squawk Box in early October.
Are there risk red flags coming up to you yet? If we're 100 and I don't know what we are as a percentage of GDP in terms of debt, but other places have gotten into trouble at similar levels in the past.
Well, sure. Not just the level of debt, the level of interest rates. Money is close to a free commodity, and when something is free, you tend not to husband it, and you tend to overuse it because like it's a free good, and so you have to be very, very cagey and alert because you know that even if you can't see them, they'll be perfectly obvious to you in hindsight. And obviously people will remember, your critics will remember having seen it and that you should have seen it, but people aren't seeing it. But you know that given that money is kind of free.
And he's basically describing the Cantillon effect. Now, for people on Main Street, the money is not free. If you're someone on Main Street, the average Joe or Jane six-pack, the money is not free. If you're a small or medium-sized business owner, you tried for a PPP loan, the money was not free. He's talking about the Wall Street banks, the large corporations, the hedge funds, the private equity guys, the parasites here in the Washington, D.C. metro area that make an extra 6 to 7 figures per year.
It presumably is not being allocated in a disciplined way, and so there are bubble elements to this, and you can see them, you can see some things, obviously the credit market, people are lending to what historically would have been viewed as weak credits for very, very little money. Look, people are lending to the U.S. Treasury for, today, 80 basis points, but for a long time, 60 basis points for 10 years as if there would never be inflation again, as if the dollars you're going to get back plus 60 basis points a year is going to compensate you for the risk you're taking. So the wash of money is clearly creating bubble elements. You look at SPACs and how much money is available on the basis of somebody's reputation, for example, as opposed to a business plan.
Exactly. No business plan, raising capital. You have Paul Ryan, who's a political crony. He's not even an investor or business owner, really. He's basically incompetent. But he learned how to do this from Mittens Romney, and he has the right political contacts. But another name for a SPAC is it's considered a blank check company. So calling something a blank check company sounds like there's going to be a lot of waste, fraud, corruption, and abuse there. You add in all this easy currency and credit sloshing around, especially for asset prices, especially with the right economic or political insiders who have access to cheaper capital, or it's a political bribe from a investment banker from a bank, like kind of a bribe, like how Nancy Pelosi got IPO shares. She was moved up to the front of the line for MasterCard and Visa many, many years ago when they went IPO, when they re-IPO'd, I guess, after they were a private company. I think they re-IPO'd 2009, 2010, and she was moved up to the front of the line. But easy currency and credit sloshing around, another perfect example of the Cantillon effect, and the SPAC madness is all part of this. And now I have some clips that I'm going to play from famous investor and short seller Jim Chanos. I respect him as an investor, as a financial analyst, finding accounting fraud. However, he's also buddy-buddy, good friends, and always talks up Joe Biden. So clearly there's some doublespeak there. There's some hypocrisy. There's the normal champagne socialist hypocrisy from rich Democrats on Wall Street. I just wanted to point that out because he always talks about how he's friends with Joe Biden, and he bashes Republicans, and he bashes Trump's administration, and it's just a lack of understanding about how corrupt all the federal government agencies are in the DC metro area by many, many people who should know. So either they know and they're lying, or they don't know and they're just ignorant. So let me play his comments here about all the capital sloshing around, SPAC madness. One of the clips is going to run for a long time, and he lays out some of the SPACs he thinks are some of the most fraudulent. So that one's going to be longer, that clip I play.
Certainly things are getting sillier and sillier and sillier. You mentioned the bankruptcy stocks. We've got this incredible SPAC mania going on, where companies that couldn't dream of going public and couldn't pass an underwriter's test now are able to go public seamlessly through a SPAC. I think we're getting about 4 or 5 filings a day now. I think we're up to that. And so the one thing I do know from my 40 years is that given enough time, Wall Street will do a very, very good job in creating supply for people that want to pay up for questionable or worthless assets.
Okay, and this interview clip is from the Hedgeye. The original webcast aired live on hedgeye.com on October 15th. It was released on November 2nd. Jim Chanos, Casino Capitalism, Fraud Mania, and Euphoria on Wall Street. Now I'm going to play the longer clip about him going more in depth about some of the SPAC waste, fraud, corruption, and abuse that he sees.
Right, there are not, frauds. They're actually pretty good stories that have underlying cash flows and assets, kinds of things that we would like. But there are a lengthening list, to your point, just by virtue of the numbers of issues out there, where it's just I don't know what else to say. CNBC trots these people out and they pump and dump on their book. I don't know about the dump side, but there's certainly the pumping going on.
Well, to talk about SPACs, you also have to marry that with the other concept that's driving the narrative side of the stock market, and that's TAM, total addressable market. Because a lot of the more egregious SPAC stories are TAM stories, right? That there's no profitability, but there is this monster market that if their algorithm, their piece of software, whatever it is that's got people excited, works, that it's just a ridiculous amount of money that they can capture from these giant markets. So think about WeWork, which...
So he's bringing up how there's some fundamental justification to kind of hide the fraud, to kind of hide all the bad fundamentals of the company. So there's some fundamental justification with the total addressable market that, hey, look, this is a large potential market where an entrepreneur can solve a problem, but the underlying business is total garbage, but people are buying into the picture, the vision instead, and not looking at all the details of problems with the company.
Never got public, disrupting the subleasing of office space. Think about Lyft and Uber, which had a monstrous TAM when they went public of disrupting basically all types of transportation. And now you're getting to kind of the absurd stuff. And we always look for companies where the business model itself is inherently and structurally unprofitable, but they try to dress it up as some sort of network effect TAM story. So consider a recent SPAC by a well-known promoter that is now in the house flipping business. And so they've taken a company that will digitally buy your house and have built a story around this and merged it into their SPAC. Now we have companies already doing this. Zillow, which is publicly traded, has a house flipping business, and it loses money on every house and makes it up on volume. And when you have business models that have discrete money losing aspects to that have no network effect, mainly you lose money on every widget but make it up on volume, you have a bad business. And if you flip houses for losses, or you sell used cars at a loss, or you make bad loans to bad credits, your TAM is almost infinite. People will flock to do business with you.
100%.
And so when people value these companies on revenues or potential revenues, you have to understand that the revenues are inherently unprofitable. Give away $20 bills for $10 on the street corner. You will have an incredible growth rate. And so this is trying to separate the wheat from the chaff. Really, right now, they're all going.
Is giving away $20 bills on the street corner, is that also called MMT? That's good for the economy, more consumption. Meanwhile, there's no real economic production in the economy. It's being totally hollowed out.
Up, right? The legitimate businesses are going up with the absurd structurally money-losing businesses. And so, it's going to take some patience, I think, and structure in your portfolio to figure out what to be long and what to be short. But there certainly is no shortage now of crazy TAM stories. One of my favorites is the sports betting market. I mean, people have just discovered sports betting. And, I'm guessing you and the boys have put a few wagers on games, maybe once or twice in your life. The sports betting total revenues in the U.S. sports betting market last year was under $1 billion. That's the win, not the handle. That's the amount that the companies kept, not the amount bet. It's probably going to be closer to $2 billion this year. And we have roughly 40% of all the states doing sports betting. But the total U.S. gambling market's $80 billion. It's been growing at about 2% a year forever, basically growing with inflation. Now, the TAM for sports betting alone, if you believe the bulls, over the next 5 to 10 years, is supposed to go to $30 billion. Well, that $30 billion is going to come out of probably the general gambling take. It's not going to be additive. And so I look at these things and say, okay, well, you basically are thinking there's going to be a 30-fold increase in the market to justify the valuations. And a lot of these companies will still be losing money 5 years into this growth rate. And sports betting is interesting. If you ever go to a casino, and Keith, I don't know if you've ever been to a casino, but
No.
the smallest amount of real estate in any casino and the least attractive amount of real estate in any casino is the sports book. It's the least profitable part of any casino.
Yep.
The win percent is about 5 to 6% versus 13%, 9% overall for a casino and 13% for slots. So again, this is not a great business. Sports betting is not a great business. I don't know of any bookies who've gotten fabulously wealthy, booking sports bets. It's amazing to me. But we've now created a TAM story around people betting on football.
Well, I mean, depending on what your proclivities are and the risks you're willing to take on an orange jumpsuit for life, there being a certain kind of a bookie can be quite profitable to a certain person, but not as a public company. I mean, it's I'm assuming that you're short DraftKings. Is this the name?
Well, I'm not going to mention what we are short some of the casino companies. I will say that
until Congress starts issuing credits for travel, for vacation vouchers to try to get the casinos back. More rules changes from Congress, but that might only be a short-term thing. Again, I agree structurally with him with the casinos. I think unless the economy comes back and there's discretionary income and traveling's easier and there's more cash flow for people and people have more discretionary income, the casinos are not going to have as much business, especially on their gambling part of their business.
Because they've got additional problems, particularly the Las Vegas casinos. And I've been a big bear on the Vegas casinos for a while now, not because of COVID. COVID has certainly made it worse, but there just is more and more competition for what was Las Vegas, which was a unique destination for years and years and years. Atlantic City was never really the competition for Las Vegas. And Las Vegas expanded well beyond gambling, about 20 years ago with the advent of the Bellagio and the Mirage. And now it became a place to go have dinner, have great restaurants, nightclubs, pools, that whole thing. Well, I'm talking to you from Miami. Miami has that right now without the gambling.
Yeah.
Millennials aren't big gamblers. And so the peak for strip casino gaming revenue was 2007. Mm-hmm. And so Vegas has had to basically compete on everything else, conventions, pools. But again, it's a no-growth market, and people are putting increasing multiples on the casino stocks because they're hoping they're going to get online and do a lot of other things. But if you actually look at the fundamentals, the numbers, they're stunningly bad. And I think sports betting is going to grow pretty rapidly for the next couple of years as the states implement it. But once you get 30, 40 states implementing it, you'll see the market slow down. And it's not as if we don't have online gambling. The UK and the EU have had it for years.
Yeah.
And William Hill just is just being bought out at a fraction of the price of where the U.S. guys trade at. It's not as if this isn't a known market. If we gamble as much as the Brits do or the Aussies do, two of the most gambling mad, societies out there, the total amount of win in U.S. sports betting will be about $4 or $5 billion, and that's if we gamble as much as the Brits and the Aussies.
Well, I think
I think the 30 billion number.
Yeah, the TAM. I mean, when you reverse engineer the TAM, that's the best way to start with these shorts. At least, our analysts would certainly agree with that. MGM's a stock that we're short, so that I think kind of fits the profile of having a significant exposure to the strip. Or you're just there are a lot of businesses like that, Jim, where baby boomers' product is not, to your point, what millennials would consider something that they want to go smoke some darts and twist the handles on slot machines. That's just not what they're doing.
Yeah, because they don't have discretionary income for that. Most millennials are ninjas, no income, no job, no assets, unfortunately. Unless you count OnlyFans.com.
There's a lot of evidence, like at least we would say. I guess back to, you're not going to give me the ticker on that. I put in flip for the house flipping SPAC, but I couldn't. Ironically, nobody has the ticker flip. That's not a ticker. That's not somebody's picked.
I think it still has the. I still think it has the ticker of the holding company. They haven't changed yet. It's IPOB.
So IPOB. So you just got the name of the house flipping special purpose acquisition company that Jim Chanos says is one of the worst ones that he's seen.
And the company is Open Door.
Now, what a name for a company that is. It says Social Capital Head of what? I mean. That is head of Sophia? That's got a long name.
Yeah, it's a well-known promoters companies. All of his companies have that name.
Oh, cool. Sounds cool.
You can look it up.
I did. All right. Well, yeah. On something that sounds like the way that you explained, I'm going to sell you something for X and just lose money on it perpetually, but tell you the TAM is large. I mean, I think we all know what company has done that with the most market cap currently today. Which is Tesla. So I mean, that thing. I actually just shorted it today.
Okay, we're not going to talk about Tesla on this. This is just about special purpose acquisition companies. I just wanted to let some of the experts weigh in on this, and I've been collecting these interviews, looking for comments about SPACs to give you guys some analysis on this. But this is definitely a side effect, an after effect of the Cantillon effect. And all this currency and credit sloshing around, and how political insiders in New York City, in the finance districts, on Wall Street, at the hedge funds, the banks, the private equity, and also the insiders here in DC like Paul Ryan were able to get access to cheaper capital and try to do these SPAC deals. And then you're going to see them over the course, as long as the stock market stays high, you're going to see these SPACs now, more of them, IPO onto retail shareholders and dumped. Please consider becoming a patron over on my Patreon and chipping in $5 or more per month, so that way I can continue to do my research and make unique content and be able to make a living. Because with my YouTube channel, my Google AdWords revenues have collapsed almost to zero. My YouTube channel subscribers have stopped growing in the last 9 months. There's no growth there. And my live stream shows have been shut down, and YouTube tech support is giving me all types of excuses, claiming that they did not put a strike on my account, even though I can't edit the title for a live stream show. I cannot turn monetization back on. I cannot even turn live chat back on. That's how bad things are with the live stream show. I have almost 150, and hopefully soon it will be over 150 unique pieces of content behind the paywall on Patreon in terms of well-researched articles. Some of the articles have taken me many, many hours to produce for lots of different topics about gold miners, silver miners, precious metal royalty and streaming companies, a lot of articles about the oil industry and other commodity industries, also global macro related articles. There's also audio podcasts and a lot of stock charts and technical analysis there too. And while you are getting unique content if I go over 1,200 patrons and I stay there, I will sign up for another live streaming service just for patrons. So I will make this pledge, I will make this promise. If I go over 1,200 patrons and I stay there, so if I drop below 1,200 patrons, the promise is not going to stay. I have to stay at 1,200 patrons and stay there. I will start to do live stream shows just for patrons behind the paywall there. Will require additional capital. I will have to sign up. I think it's $100 a month for another service there to integrate with Patreon, to sign up there and integrate. So that will be an additional added bonus for patrons if you want to take me up on that. But please chip in if you can, as YouTube is basically trying to make this impossible for me to grow my channel or to make a living from making content.